Our next guest says the trend is still your friend. Joining me now, post 9, is Chris Verrone. He's the head of technical and macro research at Strategas. Welcome back.
Great to be here.
That's the crux of your argument today is you're not that cautious. The charts look good to you?
Yeah, I think the trend is still certainly intact. We see that with a very robust recovery from, I thought, what was a modestly oversold condition back in early August. But, Scott, I think the bigger question is, as this market has rallied, has the character of the leadership changed, or certainly has the character of the macro that's driving it changed? Because we have yields under 380. We have oil breaking down. Mm-hmm. Bitcoin really hasn't been involved. So what does this tell us about kind of the broader liquidity picture, the broader attitude towards risk? And the leadership, maybe until today, has largely been fairly defensive as well.
So I brought that point up earlier.
Yeah.
It's like staples, it's utilities, it's healthcare, it's real estate. Yeah. It's those more defensive parts of the market.
What do they all have?
Is that a bad thing?
Well, I think what do they all have in common? They all have in common that lower bond yields are a tailwind here, particularly the REITs, I think particularly the biotechs. If you run sensitivity work, what sector, what group has the highest sensitivity to bond yields? It's actually small cap biotech, which is acting fantastic here. So I have to look at the REITs and the biotech. I don't think it's as defensive or as risk off as perhaps it's being advertised. It's not like they're going down but outperforming. They're still going up in price, which is a very important backdrop here. But there is some level in yield or some level in oil where you do begin to wonder, what is the message of the macro?
You say it's critical that the financials remain involved. I mean, it's been a space that's done well, obviously.
They've been essential to this market. I think what's really important, if you go back to prior soft landings, 84, 85, 94, 95, what do they have in common? Financials, as the Fed moved to non-recessionary rate cuts, financials roared out of that. Financials have roared for the last 6, 7, 8 months. I think it's essential, particularly the banks, that continues here. The brokers have been good. The insurance stocks have been good. Financials may be pausing here, but 90% of the sector is still very much involved.
I mean, do you think that continues? I know you say it's, it's essential that the space still does well. Do you have to feel, and does the chart suggest
I do, and I think what's been really driving the financials globally, they've worked in Europe, they've largely worked in Japan. Even this recent sell-off, they've been relative outperformers. It's essential that persists. My expectation is it does. We would certainly have to adjust if it stopped. And we're very much in the camp of evaluate the world you see today, play the trends that are intact, and adjust when things change. I don't think the financials have changed remotely enough to change course here.
You think the market's expecting too much from Powell at Jackson Hole?
Oh, I'm worried the opposite. I'm worried that that this Powell Fed doesn't recognize the seriousness of the 2-year yield trading 130 basis points below where the Fed funds rate is. I think it's a very, very serious message. It's only happened 4 or 5 times in history where the spread between Fed funds and 2s has been this extreme.
I think it's the largest in some 20 years.
It's the largest in, call it, summer of 07. Now, you hear 07, you always go to the very apocalyptic outcome. But remember, this happened in 89 as well. You had another year left in the economic cycle. It happened in 98 around LTCM. I think the Fed should be forceful here. I would like to see them go 50. I don't know if we're going to get it or not. Ultimately, they're going to have to. This 2-year yield is telling you where Fed funds ultimately will have to go. And I think it's essential we get there sooner rather than faster.
You think they're too data dependent? That's what you're saying.
Yeah, I do in some respects. I don't love the fact that it seems like we're getting very hung up on individual data releases. Last week it was retail sales or benign claims. I want to see the Fed look at the bond market and say, why are 2s 135 basis points below Fed funds and we're too tight? And I think the sooner they address that, the better 25 can be. The longer we let this go, I get a little bit worried. Why is oil breaking down? Why are rates lower? Why are some streaks of defensive starting to show up? That has to be monitored.
Well, I think that's why you had some on the Fed who wanted to go in July.
Yeah.
And they didn't, and now I feel like there's a sense of urgency. And you think he needs to articulate that, Powell, being he, on Friday?
I do. We always say in our work, the only Fed speaker we care about is the 2-year yield, right? The 2-year yield will tell you everything that you need to know, and it's screaming here.
That's kind of the Gunlock perspective, too. It's like the 2-year leads the Fed.
I mean, think back 2 years ago, 3 years ago, late 21. The 2-year yield was screaming on the way up that they were late. We have the exact same setup here on the other side. I just think it's one risk in an otherwise benign environment that we ought to be careful
of.
Well,
I mean, it's a big risk.
Yeah,
Maybe the biggest.
Sure.
Chris, good to see you. Thanks.
Good seeing you. Thank you.
Verrone.